My name's Hannah,
My name's Tyler. My name's Owen. I'm Caleb. And I'm Jack.
and today we're going to be talking about the Walt Disney Company. Looking at an overview of our presentation today, we'll start off with Disney's different revenue streams and how they make their money. We'll look at some risks the company currently faces, as well as some opportunities they have for growth in the future. We'll analyze their financials and some key ratios, as well as look at two growth drivers in the future, which includes their international media and entertainment segments. Then we'll look at evaluation and its current portfolio fit within the Spellman Fund, and then our recommendation summary. Looking into our current holdings, the Spellman Fund has 70 shares purchased back in 2018. We purchased that at a little above $135 per share, and it's currently trading at a little above $100. Our target price is above $110, giving us about a 9.5% return, and we are currently recommending a hold for the stock. We have a couple main reasons and drivers why the stock is going to be a great hold for the Spellman Fund, and these include increased investor confidence in the stock after the return of their CEO, Bob Iger, as well as normalizing their international segment growth and strong overall growth in their direct-to-consumer segment. Looking at an overview of their revenue streams, Disney has two major subcategories of revenue and 6 total revenue segments. Looking at linear networks, that would be their cable TV and their advertisements. They do direct-to-consumer as well, which is a new segment for Disney, which is going to be all of their streaming services. They have content and sales licensing, as well as international and domestic parks and experiences and consumer products. Right now, their most stable revenue driver is going to be their linear networks. It's been well developed in Disney for a long time. They've had stable growth over the past couple of years, as well as stable profitability. As I mentioned before, the return of their CEO, Bob Iger, has definitely boosted stockholder confidence in the stock, as well as he plans to make some changes to improve their profitability in the coming years. Looking at our recommendation as a whole, we recommend a hold because of that long-term stability, as I mentioned, as well as they're on a path of huge profitability in the direct-to-consumer segment. Our market return is going to be at 9.5% with a target return of $110. A couple challenges that they're facing currently is the shift in consumer preferences away from those linear networks being cable TV towards the streaming services, but that's also their biggest opportunity to grab some market share there, as well as become profitable. And the overall risk that we see Disney facing is if they don't become profitable in that segment, as they currently aren't, as well as not gaining that market share.
Here we have a look of Disney's 5-year stock price. In 2020, we can see they were at a low point of $86, and they rose throughout that year to their peak at $197. In the coming years, they fell to where they're currently priced at about $100. For their key statistics at the bottom, they have had an increase in EPS over the past 3 years, and a consistent ROE sitting at about 3.5%.
Here's a graph of their revenue history for the past 4 years. This graph is split into their two main segments, which is media and entertainment revenue, as well as parks, experience, and products. The average growth rate over the past 4 years has been about 7%. As seen from media on the bottom, it has been slow but constant growth, even through COVID. And then on the top, the parks and experiences received a little dip in 2020 and 2021, but has then recovered in 2022 and is on pace with growth from 2019. Diving deeper into their segment revenues, their media and entertainment is so big that it has 3 subsections, which are linear networks, and that's your cable TV shows, direct to consumer, which is more of their streaming sites, and content sales and licensing. 2 big things I want you to take away from this graph is the linear networks having 41% revenue share, then going down to 33 in 2022, and parks on the flip side having success in going from 24% revenue share up to 34%.
Looking at their ESG rating, we're rating Disney neutral overall for a variety of reasons. Just to touch on some pros of the company, they have diverse leadership and a diverse workforce. Approximately 50% of their leadership team, executive and directors, are female, and 36% are from different racial or ethnic backgrounds. Looking at environmentally, Disney works on reducing their emissions, reducing their fossil fuels and their waste continuously, and they've increased their monitoring in all those different sectors. In this past year, they generated over 200 megawatts of solar electricity, and they support over 60 nonprofits to raise up the communities that they operate in and communities around the world. Just a couple cons, they did recently do a cost reduction measure of reducing their staff by 4,000 employees, as well as some current political controversy coming out of Florida.
Here's a risk matrix. One of the biggest risks that Disney faces is viewer preference from their linear networks. Customer preference is going now to more streaming in the future. So that takes away from a lot of ad revenue. And then they need to successfully switch over to those streaming networks in the future. And that also goes along with increasing competition. Seems like every company now is coming up with direct to consumer streaming sites there. And they, with the possibility of gaining streaming market share, will be essential for revenue growth in the future.
Here we have some of Disney's key financials. We're going to first look at their net profit margin towards the bottom. It has been increasing since 2020 to now at about 3.8%. We can see that it is above Paramount and Sony, which are competitors, and a little bit above the industry average at 3.3%. At the top, we have their price to earnings ratio, which has been decreasing since 2020 and is currently sitting at about 48. It is a little higher than the industry average and higher than their competitors, Paramount and Sony, but we expect this high price comes from future market growth that the market is seeing. And at the bottom, their debt to equity has been decreasing as well to about 0.45%, which is much lower than Paramount and Sony. And that just shows how Disney is able to expand with more equity rather than debt. Onto their first growth driver in the media and entertainment section, which makes up 66% of Disney's revenue from 2022. The segment is divided into three subcategories of linear networks, direct to consumer, and content sales and licensing. Moving forward, I'm going to look at the direct to consumer, which is their streaming services. Among direct to consumer, they have about three growth opportunities. Number one being their advertisement revenue. They have $9 billion in advertisement commitment for 2023 and 2024. Disney also has room to increase Hulu and Disney Plus pricing to match competitors. Hulu is currently priced $5 below Netflix. So with these increases, we can see a $1.5 billion increase by 2025. Onto their larger growth segment, Disney is expanding into 60 countries throughout 2023, and we expect to reach about 215 million total subscribers by 2024. This would come with an $8 billion increase in revenue. Lastly, Bob Iger has a $3 billion cost-cutting focus on the direct-to-consumer segment, which comes with a 3% layoff after a 16% increase in 2022 of their workforce.
Now onto their second driver, which is international parks and experiences. The parks and experiences, both domestic and international, had 28% revenue for 2022. We decided on international because being a good driver because of the closings from COVID-19 and now those markets in Asia reopening and the expansion of new attractions in those international theme parks. Disney has 3 international theme parks, which are Paris, Hong Kong, and Shanghai, and they also receive royalty from Tokyo Disneyland. And then the big picture here is COVID-19 restrictions have stopped growth. So the reopening for those theme parks, expansions across all of those, and then the recent success of international parks. The first quarter earnings recently have shown a 27% increase as compared to Q1 last year. How we were predicting this in the future, they had a loss of about 10% from the parks in Asia. Expect that to level out, and then the historic average of about 7% increase in ticket prices. Having those two factors, as well as the expansions into each park and a little pessimistic view on the markets in Asia, bouncing back about a 15% constant growth rate. Now for international parks, the pessimistic side, there's a potential recession and it may become an unrealistic expense. And then parks may never truly bounce back from COVID-19 as well. But on the flip side, optimistically, there can be higher royalties from Tokyo Disney from their expansions, and then high growth from the rebound of COVID-19 and the expansions of parks.
On the pessimistic side for direct to consumer, Disney may fail to capture international market share. So we decreased the total subscribers by 2024 to 200 million. And this would decrease revenue by 2 billion compared to our baseline estimates. And on the other hand, they may increase their total subscribers to 245 million. And this would increase 5 billion. This would increase the revenue by 5 billion compared to our baseline estimates.
And looking at our breakdown of our EPS by segment, we can see that direct to consumer is currently in the negative, but by early as 2024, we expect this to have a positive return. And that was stated in their most recent quarter or most recent earnings report. And then for international parks, we're just expecting positive growth for the next 4 years, bringing us to a total combined EPS of $7. Looking at the EPS as a whole, we can see that our baseline EPS after a 4-year projection is around the $7 mark. But in particular, I want to draw your attention to the pessimistic EPS because our 4-year projection shows that we'd be 40% lower than our baseline. And so there's a lot of reasons that this could happen, but most particularly it comes and it's centered around Disney Plus and their expansion into 60+ countries. They failed to take away market share from already existing streaming services in those countries. Then we could see numbers that go more in line with our pessimistic EPS. And then a breakdown of our target price. For our PE method estimate, we get around a 114.70 cents. And then for our discounted cash flow method, our average value for our baseline was sitting around 108. For our weights, we did 30% weighted for our PE method and then 70% for DCF. The reasoning behind this is that ever since COVID, Disney's PE value has been highly volatile. It's gone all the way from 0 up to 283. And more recently, it's sitting around 42. But historically, before COVID, they were sitting around 12 to 20. And so based on that volatility, we decided to weight PE less and favor DCF more. And it gets us to a total baseline target price of $110.
Figure 12 shows the correlation matrix of Disney with other stocks currently in the fund. And if you look in the bottom right, you can see the two stocks with the lowest correlation are Johnson & Johnson and Pfizer. And this makes a lot of sense due to the impacts of COVID-19. So after the lockdowns came, Disney lost a large portion of its revenue, having to close many of its parks and its cruise line. On the other hand, Johnson & Johnson and Pfizer, both being medical and more specifically vaccine producers, were actually able to increase their revenue during this period. So that's why you see such a high correlation or low correlation between medical companies and Disney. On the other hand, the stock with the highest correlation is BKNG, which is Booking Inc. And this also makes sense for similar reasons. During COVID-19, Booking was unable to sell many of their vacation packages and plane tickets, so their stock price really suffered. And Disney at the same time was also struggling due to their parks and experiences segment. Figure 13 shows the breakdown of the Spellman fund by sector. And as you can see, we're actually very underweight in consumer cyclical, holding only 4% compared to 10.5% in the S&P, and very overweight in communication services, holding 19% compared to only 8% in the S&P 500. So while Disney is considered to be a communication stock, it tends to behave more like a consumer cyclical stock. And this is a big reason we decided to recommend a hold. Their parks and experiences segment is really relying on discretionary spending and people traveling. It's also important to point out that Google and Nexstar Media make up 52% of our communication sector holdings. So in order to trim down our holdings in the sector, I would recommend we look into selling one of these two companies. Figure 14 shows the breakdown of Disney's revenue by each of the two segments they report, which is media and entertainment distribution, along with parks, experiences, and products. So 36% of their revenue in October 22's quarterly report came from the parks and experiences, and a vast majority of their profit. So we believe until the media and entertainment distribution is able to grow and become more profitable, that Disney will continue to behave more like a consumer cyclical stock.
To summarize everything, both our baseline and our optimistic projections would lead to Disney being a profitable investment if we were to hold it. There's many avenues for Disney to expand into, especially considering their investments into direct to consumer. And that would bring us to a total target price for Disney for $110, which would be a return of 9.5%. And based on this information, we are recommending a hold, but that is of course dependent on the analysis of other communication sector stocks. Thank you for your time, and we're open to questions at this point.
Based on your study for Disney, are you optimistic or pessimistic about the whole economy?
About the economy as a whole.
Yeah.
Yeah, I would say I'm more optimistic about the economy. I don't think it would necessarily decline as much as some analysts are saying. I think it's possible that a recession could be coming, but I wouldn't expect for it to take a huge gigantic swing. And considering Disney is so diversified in the different industries, I don't think it would hit or impact Disney as much as something like COVID did.
Also, as we mentioned earlier, Disney's much more reliant on equity than they are debt. So even with the increase in interest rates recently, it hasn't affected Disney nearly as much as other companies in expanding.
There's like one metric to look at that is look at consumers, whether they're still confident, they're still spending enough. So go back to the slides you have for the revenue part. I think people are more interested in thinking about how the revenue where people are spending. No, keep going back. One more. Yeah, this one, right? Compared to the pre-COVID period, right? We recover from the pre-COVID period, which is 2019, right? And do you see the numbers increasing?
Yeah.
And
Based off our estimate.
yes, but approximately, if you quickly calculate about how many percent increase. Just look at those numbers.
For the entire, for Disney as a whole.
Yeah, or you can separate it.
I guess we can go to, do you want to go to the, keep going to the index? Or at least, I don't know what we should show for that.
Go back 2 slides. Because I just noticed something. You had a breakdown here showing that the parks and entertainment represent 36%. Where was that slide? So is this quarterly revenue?
Yes.
Okay, so that's why it's 28 million on the, or 28 billion, okay. Sorry.
I see about like 10% or somewhere around that. And then think about what's inflation during this period. Do you have any idea?
I guess I don't personally.
Yes. There's the numbers just show up quite
CPI,
often on the TV.
yeah, the CPI,
Yes, yes.
I believe it's currently a bit over 7%, or maybe a bit.
Yeah, I already checked it out for you, like the CPI from 2019 to 2022. Based on different resources, well, 12 to 15%. So I think it's come back, right? Just look at the consumer spending and it's come back. So I agree with you, you're optimistic. Just from this. Good.
So this is a smart ass question, but I'm gonna ask anyway. Was Disney Plus one of the 60 nonprofits they support? Did you say? Okay, no, the real question, when we look back at Disney in its heyday, which didn't seem like that long ago, they made significant investments to buy Marvel, significant investments to buy Star Wars. They parlayed that into 20 some odd Marvel movies and 3 more Star Wars movies and some Disney Plus things like that. Have those big investments fizzled out? Are they done? Or is there some additional revenue that's going to come through one of these channels, whether it's the theme parks or the media and entertainment? Or do they need to make another big investment in the franchise?
Yeah, so initially it did fizzle out a little bit when streaming started and they were licensing out that content to other services. They weren't seeing as large as a gain, which is part of the reason that they went into Disney Plus, even though obviously not operationally the best right now. But in the future, as they continue to build out Disney Plus and game membership, they should be earning more on that content that they purchased, as well as expansion in the theme parks to include more attractions based on those expansion purposes.
And is there any talk about another theme park? Because I haven't been to Disneyland, but everybody that has been talks about the lines, the cost of everything, all of this. It seems like the demand is there. But at some point, if the line is 3 miles long, you're not gonna be able to collect the revenues that you might have if you could get more people through the turnstiles.
Yeah.
An additional park.
There's been
Talk about that.
no talk about another park, but with the most recent first quarterly earnings, they have seen an increase in consumer spending from the Fast Pass and the Genie Plus line, yes. So
Okay,
there's,
with kids.
yeah,
I was there in January. They got
and
a lot of
you
money.
bought it, correct?
Absolutely.
It was worth it. So that was, they had seen a big increase in that as well. Otherwise, just the expansion into different parks, different experiences in those parks. And there's also plans in 2024 for a new cruise ship, but that is.
I think just ask about ratios all the time. It makes me bored on my mind. So let me ask a question. Sorry. Did I say that out loud? I'm interested in the politics and how it affects your sort of assessment of course investment. Right? Like, so, you know, what is happening between Disney and DeSantis? And then what kind of risks does that present to the portfolio? And how would you weigh that in your decision making?
Yeah, so currently politically, there is a disagreement between Disney,
Is that what you call it? Disagreement? Okay.
a strong disagreement between,
Differences of opinions.
yes, in between Disney and the governor. And so basically, Disney had one opinion regarding education and a bill that was passed, and the government had a different opinion. And so Disney spoke out against it, and the governor didn't necessarily like that so much. So kind of fired back a little bit against Disney. Disney has basically governed itself in Florida because it has such large tax revenues. It employs so many people, and it's just a very big revenue driver for Florida as a whole. And so they had their own government. The government decided to step in and make a board to basically legislate Disney a little heavier. And so there's been a lot of back and forth between there. Disney did come out with a lawsuit against the governor's office, and we haven't seen any result of that yet. But then the governor did come back towards Disney again, and they are pushing a bill through the Senate to limit Disney's expansion. So there hasn't come anything of that yet, but likely because of the impact that Disney has on the Florida economy, as well as Disney obviously wanting to keep a good relationship overall there in the long run, they'll likely come to some settlement or some sort of agreement in the future.
So what are the risks? Like if this escalates further, or like what are the risks that they face as a brand and all of the products? And how would you weigh that financially at the moment?
So, yeah, I mean, while their theme park in Florida is a big part of their revenue, they do have a very diverse revenue stream. So they're able to generate revenue through their 5 other international parks, as well as the California park, and then also the media and entertainment revenue. So even if everything were to go, you know, really poorly with the Florida government, I don't see it hurting the company too much in the long run.
Okay.
Do you know offhand what the percentage of their total revenues based off of?
I'm not sure.
No, we don't have, I guess, Florida in particular, just
Just
domestic.
curious, but to your
Yeah,
point,
I'll
like,
have to look that up.
worst case scenario, they shut the doors.
What does that look like?
What
But
is-
that's not the worst case scenario. The worst case scenario is they shut their doors and this DeSantis has sort of public opinion on his side and consumers for all Disney products. Well, like, you know, I Disney Plus, that's it, right? But so then it contaminates the rest of the brand in a way that affects growth, right? So it's not just about the park at the end of the day for them as a company, a brand and identity. And so it's risky, you know. Someone was saying earlier when we were talking that you know, Disney's been looking for Patriots to step up and support them, and you know, not anybody behind them at the moment, just because of the risk to the brand, not just the park.
You go right. You mentioned Bob Iger 3 times. Finish the sentence. So what? So, okay, Bob Iger's back. So tell me what that means.
Yeah, so he led the company obviously for a pretty long time, and he brought them to profitability, and he had a really good reputation within the company. And so they ousted their CEO and brought Bob back out of retirement from being on the chair of the board. And so he's focusing on major efficiencies within the company. He wanted to do layoffs, which we mentioned in the presentation, but he's also focusing on bringing profitability to the direct-to-consumer segment because Disney's invested so much there. And then I think overall just improving the efficiency and the systems of Disney. And he's also shifting the segments that Disney focuses on from the ones we discussed here today to different overall operating segments.
And Bob Iger it is a 2-year contract, and the main his main goal was to reinstate the confidence of the stakeholders in Disney. So he wants to, as he did, what was it, 7,000 jobs were cut as well. And so these next 2 years, he's really working on profitability and getting that revenue.
So is there a connection to that, to our previous discussion? Is there a loss of confidence because of the, what did you call it, disagreement? Is there a connection or is it purely financial?
I would say there could be a connection there. Some of the missteps that one might view them as missteps, one might not, but some of the steps that were taken might have been hasty or too late in different people's opinions. And overall, the board didn't like the way that the previous CEO had been operating Disney. So that's one of the main reasons he did come back, because the situation wasn't necessarily handled in the way that it could have been.
Can you go to the slide with the ratios and the competitors? Answer ratios. Well, I'm not gonna answer a ratio question. It's a bit more philosophical. I got philosophical questions for you, so. Some ratios. You picked as your competitors, your two main ones, Powerhouse, Paramount, Superstar, Sony. Just out of curiosity, why did you select those two, given the I don't know, size diversity of Disney across different segments?
Yeah, so looking at the competitors, it's kind of hard to find something exactly like Disney because of all the revenue streams. So we picked those ones kind of just based off of more their media and entertainment related. And then I also have in our slide, I have like a better breakdown of just profit margins for their media and entertainment, which is like better comparable to those two. Maybe I don't have it, but yeah, just overall, basically their media and entertainment segments.
So dumb question, why wouldn't you, given the focus on kind of the media, streaming and all that, like why not Netflix? On the park side, you have Comcast with, their parks. Did you go to their parks at all? No. Just kind of try to get in your head as to why you pick what you pick, because when you're doing comparisons, this is more like you guys have sometimes later in life when you're doing comparisons, it's like you can cherry pick certain things and you put Paramount up there and ratios look horrible and makes Disney look good. Which is fine if it's a true competitor, but given the size and difficulties they have, I think you could probably argue against that. So, needless to say, the point is be careful and very thoughtful when you're putting statistics up, putting up competitors, and then average it too, because you can say, well, look at this over a time period, and one or two numbers could be like COVID, for example, probably skewed a lot of your numbers as well. One of the questions I had was, what was Parks previously, but then he went back to 18, saw that's what it was. I don't know if that was a peak or not, but philosophically, that's the one thing I wanted to kind of throw at you guys. And then you guys kept talking about, holding. You guys got 10% upside. You seem pretty enthusiastic about stock in general. Why not buy? If you pull up the price chart, I don't know, do you have any idea what we pay for it?
135.
135, where is it at now?
Right now it's at 100.
At 100? So you're just looking at the price chart that you guys threw up there.
Yeah.
Keep going, one or two slides. There we go. When you look at that, you're like, got to almost $200. You're at half of that. You guys got some decent returns. Why not buy?
I think it definitely could be a buy if it wasn't so overweight in the communication sector, even though we did discuss that it kind of behaves more like a cyclical. I think in the future, a group could come and maybe talk about whether we should buy more of the stock or even sell it then. But right now, just a hold, I think, overall.
Just really not in a position to buy any of these stocks until we cut our holdings in either Nexstar or Google, since we're so overweight.
I got that part, but I also want to hear what would it take you to get you over the top?
I think too, having that positive profit margin in the direct to consumer segment would be a big.
I would say proving they can expand internationally with their streaming service, because that's going to be a huge part of their future growth. So proving that they're able to do that, I think would make it a buy.
Is there anything else? Looks like I have one last. Wait, go to slide 16. Does anyone on the board or anyone sitting in the stands, the cheap seats, seen a slide broken out like this before? You think, especially you guys on the cheap seats, do you guys think that would have been pretty helpful when explaining your story? The answer is yes. I want to compliment you on this. This is, I think, the first time that I've seen somebody actually explain it this way versus trying to like just quickly go through the slide. And when you explain it, excuse me, this way, like here really is the main points. It helps us see, okay, this is why, you know, kind of thought process behind things. So I really like this slide, and I would advocate to my future groups that they actually build something similar, because it helps tell your story, really lays it out nicely versus these rapid fire quick hits that I'm juggling trying to figure things out. So
Good job.